Hello, people. Today we are moving to a new chapter, chapter number 7, Foreign Exchange Derivatives. Previously, in chapter 5, I covered forward contract, and I mentioned how to use forward contract to conduct trading, especially covered interest arbitrage. And in this chapter 7, I'm going to talk about futures and options. And futures is very similar to forward in terms of signing a contract to make the delivery and payment of a certain product in a future date. And the price would be predetermined. Before I get to all the calculations and theories, I just want to add some flavors to the class by showing you some historical stories. If you go to France, you never miss the Louvre Museum, and you will see Mona Lisa, and you will also be able to find the Hammurabi Code. Hammurabi Code is a stone recording all the laws at the ancient Babylonian period, which is about 4,500 years ago. And in this code of law, there records how to conduct a futures contract. Okay, so a buyer and a seller would meet together and determine a price, a delivery of a product in the future. It has to be handwritten, there has to be a witness, and so on. So that's the first prototype of a forward and a futures we use. So what's the difference between futures and forward? Futures is more standardized. The contract of the futures could be transferred, could be resale to other parties, whereas the forward is more individualized. The two parties sign the forward contract and they cannot transfer this contract, and the actual delivery of the products have to be made based on the forward. Okay, so the first human futures trading market arguably happened in Japan about 400 years ago. You know, all these Japanese samurais, and they were very loyal to their masters. They are very brave to kill others and kill themselves. Anyways, you should know that at that time, the samurais are paid in rice, okay, bags of rice, not in gold, not in the prevailing currency at that time. And when the samurais receive their annual paycheck, a lot of rice, of course, they would be worried about the rice price in the future when they receive their salary, okay? And then they want to kill that uncertainty by making some deals today with the merchants in Japan, and to lock in a predetermined price. So when the harvest time comes, when the samurais themselves get paid, they would be able to sell at a fixed price. And then there emerged this Dojima rice exchange futures market. On one hand side, you see a lot of samurais. On the other hand side, you see a lot of merchants. So all they're doing was to deal with the futures. And right here is a picture of a futures contract. And in the futures contract, it records a standardized size of rice, and also a standardized price to pay for that amount of rice. And this piece of paper, which is a futures security, could be resold to another party for profit purposes. And right here, on the other side of the world, we have the Europe, especially the Dutch. They are pretty good at conducting the securities trading. The first corporation in the world was founded by the Dutch. It's called the East Indian Company. Of course, the British also founded another company with the same name, but the Dutch one is earlier. And the Dutch also developed a futures trading market. At that time, that market was serving for the trading of tulips only. You know, tulip is a very beautiful flower. You go to Netherlands, you see this windmill, you see a lot of tulips, especially in April. And the Dutch people had such a favor, even frenzy, about the tulips. The tulip price become soaring at that time. It's 300, 400 years ago. At that time, the trading currency in Holland was guilder. You know that the tulip, the flower, doesn't last long from the time it bloomed until the time it withers. It only lasts for no more than a month. And when people want to conduct massive trading of tulips, they have to prepare much longer beforehand to determine the price, determine the terms of delivery of the product. In other words, they have to use the futures to trade the tulips. So the futures could be signed 3 months before the tulip blossom. Okay, so they cannot do a spot trading at that time. You don't see everybody just bring a tulip into a centralized market. It's not like that. So if you want to trade tulip as a commodity, then you should use the futures. And at that time, the Dutch people frenzy. So you could see that the tulip futures price started from 25 guilder all the way to 200 guilder, and then it just the bubble just bursted, and then it just plummeted to the original level. And here is a tulip futures contract signed in different languages, sealed, of course, by the authority of the exchange. Right here, you see the top price is 200 guilder. You may wonder how much can that buy. Of course, it could buy a tulip when it blossom at the maturity date, and this 200 guilder can also buy a mansion at the port of Amsterdam. It's just like you buying a penthouse on the 5th Street of New York. So it's that expensive just for one single flower. So you can imagine how crazy people were. And now time move to the modern time. We see the Chicago Board of Trade. It is in Chicago. So now Chicago Mercantile Exchange Group. The exchange used to be called the Chicago Board of Trade. And it was established in the mid-19th century when the agricultural products in the Middle West was shipped to the New England area and also all the other areas through the Five Lakes and all the other transportation system. So Chicago was a hub for all this product trading. And of course, if you want to trade a massive amount of agricultural products, you have to plan ahead. You have to plan 3 months or 6 months ahead to set up the terms of a delivery and also lock in a predetermined price. All right. On the other side, the existence of such a futures trading provides insurance to the farmers, just like the futures in Japan provides insurance to the samurai who will sell their rice salary. The farmers in the Midwest also need the futures to sell their agricultural product without risk. So this is the headquarters of the CME in downtown Chicago. I'm sure you guys may have seen this. This guy is the president, the CEO of the CME. His name is Terry Duffy, and he used to study at St. Xavier University. You may know that. All right, so now the CME offers a lot of products, not only the agricultural products like the soybeans, the corns, but also the energy product like a crude oil, which is priced negatively right now at this point. There's also stock market index fund like a Standard & Poor's 500, NASDAQ 100. There's also a treasury bill product. So these are 10-year treasury notes, 5-year treasury notes. There's also a foreign exchange, of course. The foreign currencies is another important part of their products. So when you trade all these products, you are not trading on spot. You are not buying 50 tons of corns at the CME. You are trading futures. Okay, you are trading the securities. The terminology we use here is derivatives. The futures, the forwards, and later the options are all derivatives because their value may change according to their underlying assets. If the euro appreciates, then the futures value of the euro would also appreciate. If the oil price dropped down, then the future price of the price of the oil futures would also drop down. In the PowerPoint posted on the Canvas for Chapter 7, at the beginning, I compare and contrast the forward contracts and the futures contract. So they have some certain similarities, like they all set up the settlement in the future. And the futures is different because the futures is more standardized in number of units per trade. and also it offers more liquidity. That means that the futures are easier to buy and to sell, to buy and resell over and over again. And also typically offered based on US dollars. That's for the exchange of futures. And there could also be cross rates. And the large place for trading futures, currency futures, would be the CME in downtown Chicago. And then talking about the standardization of the futures contract for exchange rates. So we have all these currencies, as you can see, for each one contract, which is the minimum amount you can trade, is listed here. For Australian dollar, that's 100,000 Australian dollar per contract. So that's roughly 50,000 US dollars. And for Chinese yuan, that's 1 million Chinese yuan. That's roughly 150,000 US dollars. Although these numbers are at a different magnitude, the thing is some currencies are denominated in bigger numbers, like a Korean won and the Japanese yen. And some currencies are denominated in smaller numbers, like euros and the British pound. But if you convert all of these numbers in other currencies into US dollars, then the size is very comparable. It's not too far away from each other. The dollar needs to trade one Australian dollar contract, and the US dollar needs to trade one Swedish krona contract, will not be that much different. Okay, so how do you conduct the futures trading for currencies? Of course, you need to have a brokerage firm, and the CME has a lot of brokers, either electronically or on the floor. And a lot of the tradings nowadays are done electronically through these platforms. You see the CME has evolved. It used to have 8,000 employees working on that building, and now it only have several hundred. So you can see the technology has replaced a lot of manpowers. Okay, and here is a more detailed comparison between forward and futures. So for the size of a contract, the forward is more individualized. You can set a contract of $3 or let's say $179 million and the 0.05 cents. Okay, any number you like to put in the contract, that's fine. But for futures, it has to be 100,000 Australian dollars, 100,000 New Zealand dollars. That's kind of a standard amount. And the delivery date for the forward is also individualized between the two parties. But for the futures, it's very standardized. The delivery of futures of all these commodities, no matter the currencies or beef or oil, it has to be on certain date. Usually, it is the third Wednesday of every March, June, September, and December. Okay, and also the participants of a forward is usually between a multinational corporations who are doing exports and imports. They need a currency exchange, and they have to pair up with a commercial bank like a Bank of America or JP Morgan Chase. And for futures, there could be a lot of speculators doing the trades. And for forward, there's no deposit required. You just sign a contract and make the payment in the future, and that's it. But for futures, you do have to put a certain deposit up front. The deposit could be 3 to 12% of your trading volume based on the definition of the Chicago Mercantile Exchange. And for forward, there's no separate clearinghouse. In the previous chapters, I explained the clearinghouse as a hub of transactions. So each party who needs to buy or sell just trade with the clearinghouse instead of trading with each other. But that's not the case for forward. The forward market, there's no clearinghouse. The buyer and the seller just pair with each other and then trade. For futures, there is a clearinghouse, and the Chicago Mercantile Exchange or some other futures exchange like the Singapore Futures Exchange, the Futures Exchange in Korea, in Netherlands, they all serve as clearinghouses. And the work is done electronically. You need telecommunication networks. And for futures, there is a centralized exchange floor in addition to the network. And for regulations, the forward is self-regulated. It just need to follow the contract law of the country. And for the futures, since the futures is a security which can be purchased and then resold, there needs to be more regulations on these securities. So you have the Securities Exchange Commission, which is a federal agency to oversee the financial markets in this country. You also have the Commodity Futures Trading Commission, just designed to supervise the futures trading only, and also the National Futures Association. And for liquidation means you sell off your products or you purchase the product and make the transaction cleared. In the forward contract, there's always most of the contract resulted in actual delivery. If a Boeing wants to buy 50,000 British pound, then it will buy 50,000 British pound when the contract is due. But that's not the case for futures. If some individual wants to trade on British pound at 50,000 pounds level, they may just buy and sell, or they may sell first and then buy later. Hopefully, they can buy low and sell high, no matter which comes first, in order to lock in a profit. So in that case, the futures trading is usually offset each other. So the individuals often buy and sell or sell and buy. So each pair of buy-sell trading would cancel each other. Okay. And for transaction cost, there is a spread between the bank's buy and sell prices, which we called bid and ask. All right. And for futures, you just need to pay the brokerage fees to the CME. So the more trading you do in the CME, the more money the CME makes. And here is one example to trade Australian dollar. So you will see that on January the 10th, you are looking at a futures contract, which is a deal which will be settled on March the 19th. On January the 10th, the price of the futures, which will occur in March, is $0.53 per Australian dollar. Okay. And this individual trader make the contract to buy, but he or she does not need to pay any penny at this point. They just need to buy the futures and sign a contract, and they also need to put in some deposit, not the money for trading directly. And then on March the 15th, this person make the contract to sell, but at the time it sells, the price is only 50 cents. It actually dropped. And again, this contract is a same contract which is due on March the 19th. So this person on March the 19th will settle two contracts. One is to buy at 53 cents and another is to sell at 50 cents. And jointly, this person will have $0.03 per Australian dollar multiplied by 100,000 Australian dollars, then that's going to be $3,000 loss. So just take a look at this part. Why does this person choose to sell at an unfavorable price? Well, if you see this person keeps holding the buy contract and not to clear its position before the due date, then this person will have to buy 100,000 Australian dollars. Why in the world does this individual American trader wants to hold 100,000 Australian dollars in his or her pocket or bank account? He or she is not using Australian dollar. He just play with Australian dollar for the sole purpose of making money, of getting speculative profit. The only situation in this case is that he or she didn't get lucky. Okay, he has to clear the position, although he has to suffer a loss, but it's better than holding 100,000 Australian dollars without any use of it. The futures market is a very efficient market. If you take a look at the buying side and the selling side, you see the buyers and the sellers, they compete with each other, and they all possess different amount of information. So it's a zero-sum game, essentially speaking. So when some people make money, that's the money the other group of people loses. The only person who will get profit for sure is the exchange floor, which is the Chicago Mercantile Exchange. They charge all the traders brokerage fees no matter they buy or sell. Okay, then who would make money? The people who have better information would prevail in this war game. And if these people have a better information, then they would take position ahead of the market and then taking advantage of this information to earn abnormal profit. When we say a market is efficient, that basically means all the information regarding to these assets, could be oil, could be euros, is available to everybody in the market. So an efficient market basically means everybody knows everything. However, that's not the case. Some individual or some parties do possess information advantage over another group of traders, and this information advantage would lead to abnormal profits. So people trade currency futures based on their expectations, of course, and their expectations would be based on the information they collected, they analyzed, and then disseminated. If you as an individual trader, if you don't have a better source of information other than just looking at the trading prices or the curves, then you shouldn't be in the game. If you don't have information advantage, you should not be in the game. Okay, and definitely if you trade based on your expectation, no matter how well you are informed, you only possess a piece of the information of all sets of the information the market absorbs. So your own piece of information could be good. Even it is certainly good, it is not certainly would make you money because there may be also some news, some information which would be against your favor. For example, if you know the interest in the Eurozone will increase, so that basically means the Euro will appreciate, so you will buy the Euro's futures now, hopefully to take advantage of appreciated Euro. However, in the there's some other information you don't know, like the inflation in the Euro may also go up higher, even higher than the interest, which make the Euro eventually depreciate. So in that case, you lose money, despite the fact that you possess some good information. So this market is always very risky. What makes it more risky? The deposit system. To play the futures trading, you will only need to deposit 5% of your trading volume. So that means if the assets value change by 5%, and it could evaporate your entire deposit, okay? Then you would no money at all. And right here, let me just use some chart to show you the difference between the spot market trading of the foreign currency exchange and also the futures trading. So let's see, this chart is not a demand supply chart anymore. So it is the price chart. So this is a spot rate. This is a spot rate. And you have all the dollar price, it goes like this. And this is the timeline. Okay, this is a timeline. Right here is a today, and then you have a day 1, day 2, and all the way to day 100 or whatever. So let's say if you have $100 in your hand, then you want to buy at a low level. Let's see, this is where you place your position right here. You make a buy order. Okay, and you want to sell somewhere right here. So you will buy this day, you pay $100, and right here you sell. Let's say this euro appreciated by 10%. This is a 10% increase. So how much do you get when you sell? You will receive $110. So that's how much money you would make. So if we look at the futures market, it's a different game, futures. And again, we're talking about the euros. And we have the settlement date of the euros. Let's say the settlement date is the 3rd Wednesday of June this year. So it's going to be June the 17th. All right, so we have a euros settled on June the 17th, 2020. Okay, so let's say this is the settlement date. So, and the price curve you see just like the price curve you saw in the spot market. Okay, it's just to go up and down with volatility. Sometimes it's an upward trend, but it's not really appreciation of the euro. It's the expectation of appreciation of euro at the settlement date. Okay, so this again is this time is today. So how much euro can you trade? At the CME says when you trade the futures on their floor, the deposit is 3 to 12%. So let's just make it 10%. So based on your endowment of $100, so you can just put $100 as deposit of the 10% of your trading volume. and then $100 divided by 10% would give you $1,000. So that's how much you can trade. This is your trading volume, maximum trading volume, I should say. Okay, then you want to take advantage of the situation. You may know some better information than the others. So let's say right here, you made a buy order. You saw the price will go up. Then you just wait until it reaches to a top and then it declines. Let's say you just made a sell order right here. Okay, let's see the price increase by 40%. Okay, the price increased by 40%. So in this case, you can buy and sell, but there's no cash flow here. There's no cash flow here. Okay, there will be settlement at the settlement date, okay, which is June 17th. So on June 17th, you will pay $1,000 to buy the euros, and then you will make up a 40% return. So you will get $1,400, and your overall profit is $400. Okay, so that sounds very, very sweet. You just started with $100, but you work out a profit of $400. Okay, so that's 4 times of your deposit or your initial investment. So now let's have another situation. Let's see right here. You think the price is dropping from another peak, so you sell the future. Don't worry about whether you have the euro to sell or not. You just made yourself a commitment right here to sell that amount of euros at the settlement date. Okay, does that make sense? Okay, and then what you hope for is that the euro would, as the futures price would decline to anywhere that is below the selling price. Okay, let's see. The euro is right here. Okay, it's right here. So let's see if the euro just decline and then you just reach it back here, and then you made a commitment to buy. So you buy a futures contract, and there's no cash flow here, no cash flow here. Again, your $100 deposit was deposited at a time 0. All right, so that's the negative $100 deposit over there. But when you sell the futures and buy the futures, at the moment of making the contract, there's no delivery of cash. But if you do the spot market trading on the top, you will see when you buy or sell, you have to pay or receive the money. Let's see, the percentage drop is another 30%. So which means at the settlement date, you will sell and buy simultaneously. If you sell, you will sell at $1,000. And then when you buy, you just pay $600. And altogether, you made another $400 profit. Okay, which also sounds pretty good. So the reason I do this here is not to encourage to engage in futures trading. There could be some losses, of course. I just want to compare the difference between futures trading right here and spot trading up there. The major difference is the delivery is made at the settlement date, not the time you submit your order. And this futures price, as you see, it goes up and down, is always about the expectation of the exchange rate at the settlement date on June 17th, 2020. Okay, so right here, people think it's low. Right here, people think the rate at the same time on June 17th is higher. And right here, people again, based on some newly developed information, people think the euro is going to be low. And then some new information come out, some positive information come out, then the market believes the euro price will be high at the settlement date. Okay, so let's see, what about if there is a losing situation? How could you have a loss? Let's say again, this is the futures price, and this is the time. Let's say this future has a settlement date. This time is the third Wednesday of September, which is September the 16th. Okay, so at September the 16th of 2020. Alrighty, so the market also have expectations of the euro rate on that particular date. Again, right here, people think it's going to be low, and right here, some positive information come up. People think euro will going to be high, and then some negative information come up at the market level. Then people think euro is going to be low. When it's going down, that must be some negative information coming up. When it's going up, there must be some positive information coming up. And it's all about the euro rate on September the 16th. So let's say right here, you think the euro prices will go up, so you made a buy order, all right? But however, that is not really the case. Your expectation is that the euro will appreciate, but the euro actually depreciate later. And in your expectation, you think it's going to be like this. Okay, this is your expectation, because right here you don't see all of this actual what the future is going to actually be. You just based on your expectation that the rate will be even worse. You don't see this part, and this is what you think the exchange would be. So then you would make an order to sell. Okay, you would have made an order to sell. You just don't know this part yet at this time, all right? Because this would be the future, and this is what your forecast, which is incredibly inaccurate, all right? If you know what happened in the future, then you would keep your buying position. Okay, so if you take a look right here, then if you buy, once again, there's no cash flow here. If you sell, there's no cash flow here. But you do have to make the settlement at the settlement date, which requires you to buy and sell simultaneously. It's a two futures contract. You buy, you pay 1,000 US dollar, or the equivalent amount of euros, and when you sell, you can only sell at 500 US dollars for the same amount of euro you purchase. So if you buy, you pay the money. If you sell, you receive the money. And altogether, you have a negative $500 loss. And remember, to play the game, you need to first start with a $100 deposit at a time 0 right here. Okay, and from a $100 deposit, that's your investment, you actually have a $500 loss. So that means not only your $100 was marked off from your book account. In order to keep your position when the futures is declining, you have to add in more money, 100, another 100, another 100, another 100. So when the futures price just keeps it down, and you want to hold your position at a loss, then you have to deposit more and more money. And then right here, you just choose to liquidate your position. So this original $100 is gone, plus another $400 you add it in for additional margin requirement. Okay, so why does this person want to sell right here? Why not just hold 1,000 euros until the end, until the settlement date? So what happens if this person doesn't sell right here? Well, the thing is, if it doesn't sell and it just be brave and hold it until right here, true, there's not much of a losses because the price he or she buys here and the market rate would be the same. But at that time, as I said, this person doesn't know. All right, this person doesn't know, and he or she thought the price will be this low, and which is worse. This price is worse than the price he actually sell. Once again, nobody knows the future with a crystal ball, and this is the best guess of this person. If this is that bad, so it's better to sell right here when it's not that bad. But this person definitely will regret because it did turn out to be a better situation. So in this case, the person actually lose $500 for the $100 it deposit, and that's a negative 400% loss. In the previous examples, I said that there's no possible negative 100% loss. That basically means you lose everything. And in the futures game, you can lose everything. You can lose all the $100 you deposit as investment, but it also requires you to lose more and more money as additional margin requirement in addition to the loss of your investment. Okay, and this this loss over negative 100% only exists in margins trading when you borrow money to play the game, or just put a deposit to play the game, and the rest of the money will be borrowed.